Hi everybody, my name is Griffin Bridgers. Today I'm here to discuss a recent Chief Counsel Advice 2023-02012, which deals with charitable contributions of cryptocurrency and how you substantiate value for purposes of receiving the charitable income tax deduction. As always, I want to remind you this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, to give you the lay of the land, often when we look at charitable contributions, we think of such contributions being in the form of cash, which requires very little substantiation in the grand scheme of things. However, for larger contributions, it's frequent that non-cash contributions will be made. And whether you have cash or non-cash, once you get over a certain dollar amount, you may have to have certain requirements met as well. Strict compliance has been a common theme in the past year when we look at charitable contributions and whether those contributions are indeed deductible by the donor under Code Section 170. A recent case from this past summer, Kiefer versus United States, really highlighted this, where a charitable contribution to a donor-advised fund was not allowed to have a corresponding deduction because the fund failed to provide a contemporaneous written acknowledgement that the fund would have control of the assets as was required under Code Section 170 F18. So, while not as significant as this district court case, there is a growing issue too on the property side, especially with cryptocurrency. Generally, non-cash charitable contributions, which are over $5,000, require the filing of IRS Form 8283, which usually has to be accompanied by a qualified appraisal for most types of property. Some types of property are excluded, such as publicly traded securities, because you can easily obtain a value for securities on an exchange. However, how does cryptocurrency fit into this? Crypto has oftentimes active exchanges where you can obtain a value, but otherwise, is it cash? Is it like a publicly traded security? Or is it property? And if so, how do we substantiate the value of crypto that is being donated to charity? Well, recent Chief Counsel Advice Memorandum 2023-02012 addressed this issue. And what it concluded was, as we're going to see, that you have to have a qualified appraisal for cryptocurrency. So what happened here is this was a situation where a taxpayer had donated crypto in excess of $5,000 to a charity and completed Form 8283 as required, but failed to attach a qualified appraisal and instead relied on the value from a cryptocurrency exchange. And there's a variety of places you can find that. Most finance websites have it. If you go on Coinbase, you can find exchange values. And really what happened here is that the taxpayer attempted to treat this like it was a publicly traded security. However, keep in mind this strict compliance requirement. And the Office of IRS Chief Counsel disagreed with that method of compliance. They said, look, this is not going to be a publicly traded security. You can't just pull a value off of an exchange. You have to go through the exercise of obtaining a qualified appraisal in order to get the income tax deduction for a donation of cryptocurrency. Why? Well, there was a recent change to Code Section 6045 at the end of last year through one of the Investment and Inflation Acts. I forget the exact name of such act, but one of the changes was that cryptocurrency is classified as a digital asset, and digital assets are classified as property under Code Section 6045. Now, that change or clarification created its own set of reporting requirements for sales and exchanges, which have been kind of ongoing and developing over the last few years. However, the changes did not directly address reporting for charitable contribution purposes. However, because we have this definition where technically crypto is property, what the Office of Chief Counsel determined is that because of that, you have to have a qualified appraisal for property. Now, there's some carve-outs, like I said, for publicly traded securities, but this is not a publicly traded security. Crypto is not going to have that same definition and is not going to allow a donor to avail themselves of an easy path to reporting the value. So ultimately, instead of relying on an exchange value, donors of cryptocurrency now have to go through the exercise of obtaining a qualified appraisal and attaching that with Form 8283 if crypto is contributed to a charity. So what are our key lessons and takeaways here? It's relatively simple in the grand scheme of things. If you have clients who are donating cryptocurrency, make sure you obtain a qualified appraisal as part of the Form 8283 filing. And if you are working with a charitable organization or a donor-advised fund that receives cryptocurrency donations, may be helpful to remind donors of these obligations, that there's no ability to really just take the exchange value and throw that onto your income tax return. You have to go through the exercise of getting a qualified appraisal. It also helps to keep in mind the ripple effects of this property classification and look at that downstream. How might that affect the bigger picture of Code Section 170 and donations of cryptocurrency in general? This is just one example that came to mind, but consider maybe that cryptocurrency would be capital gain property and thus eligible for the Code Section 170 E1B reduction election, where you can treat the basis of the cryptocurrency as your contribution amount in lieu of the fair market value, so as to avail yourself of a larger AGI limitation when determining how much can be deducted in any given year. So simple lesson here, but also pretty significant in terms of the tax effects of this requirement and the compliance effects of having to get a qualified appraisal for cryptocurrency donated to charity. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. I've gotten a number of emails lately where it is obvious that it's somebody seeking legal or tax advice, which I just simply cannot give or even respond to. So if you send an email like that, I probably won't respond. But if you're a tax or estate planning practitioner, I'm happy to assist you in your learning process. And the reason I do this is because I am looking for speaking engagements. So if you need a speaker for an estate planning council event or a CLE program, bar association, or even a conference or in-house program, feel free to reach out as well. But thanks again for listening to this video, and I look forward to seeing you in my future content.